Inflation levels rising to their highest in more than 3 decades. Prices increasing 6.2% year over year. That's the Consumer Price Index. And Americans are feeling these increases in cost across the country, some areas more than others. Prices in the Midwest up 7.3%. Joining me now, Wells Fargo Investment Institute head global market strategist Paul Christopher, and joining the conversation all morning long, Jackie DeAngelis and James Freeman. Paul, you say inflation's uptrend is a perfect storm of strong demand, but how much more can the market keep running if inflation is, as Kevin Hassett said, he thinks it'll hit 8 to 10% inflation in a few months?
We do agree, and by the way, good morning, Dagan. We do agree that inflation hasn't peaked yet. Whether it's going to be in the 6-handle range or the 7-handle range, we're not sure. And if it were to stay there, that would be a negative for both bonds and stocks in investors' portfolios. But we agree that it's going to peak soon. We're already seeing signs. Things like falling transportation, dramatically falling transportation costs are very encouraging. Pickups in production from factories in Asia, that's another strong positive going forward. And look, as inflation rises and people dip into their savings, they're just going to be buying fewer goods and they're going to be switching to services. And that ease in demand will do a lot to rebalance supply and demand, will help to bring inflation, we think, considerably lower by the end of 2022.
Yeah, but inflation begets inflation, does it not? That when people in their mindset factor start anticipating higher inflation, that they actually cause it. I don't know. It seems like that this is, the Fed has said, and even Janet Yellen at the Treasury has said that they won't allow it to get to 70s levels too late.
Well, in the 70s, the peaks in inflation were closer to 15%. I don't think anybody's talking about inflation quite that high. But yes, you're right. If inflation does become self-sustaining, if people start to expect that it's going to be higher tomorrow because it was up from yesterday, then that's a problem. And there is a risk there. Wages and rents are the two things we're watching most closely. But we do think that wages in particular will be capped soon. You know, we're starting to see an improvement in labor force participation. We're also seeing people start to dip into those savings that accumulated a lot during 2019 and 2020. And as those savings balances come down, you'll see people come back into the workforce, into those manufacturing and leisure and hospitality industries where most of the job openings and most of the wage gains are. We think that, again, is going to be a rebalancing between labor supply and demand.
James?
Paul, let's say inflation doesn't get to that 1970s 15% level, but let's say it's not transitory. Let's say 6.2% is what we get for next year. What does that do to the economy?
That's going to be, well, you can always think of inflation as a friction. In fact, people think of inflation as sort of being related to heat in the economy. And if you have that kind of friction in the economy going forward, a 6% plus rate for more than a year, that would be damaging. It's going to reduce purchasing power, and it's going to slow the economy by more than most of us on Wall Street think that's possible to do. And then that's going to start hitting earnings.
Jackie, jump in here.
Yeah, you know, I'm a very financially disciplined person, Paul, so I haven't dipped into savings to buy things that I don't necessarily need right now. But I know the rest of America isn't exactly like that. And so I wonder how long you think that will last. And I'm not necessarily sure that demand is part of the driver of inflation, but isn't also part of it the supply chain shortage and the labor shortage? Everything sort of rolled up into one. The demand is just sort of a supporting problem.
Paul, did you hear that?
I think
you're absolutely right. The supply is it's a big problem. And supply has been scrambled by all of these COVID-related issues and some inefficiencies in transportation systems that we've discovered that were lurking there, but were revealed by this very strong demand. But again, if transportation costs are starting to fall, it means that companies are finding ways around those bottlenecks. We think that solution set continues to grow. You might see more, for example, warehouses at intermediate points. That's going to create jobs, by the way, and it's going to create create more spending by businesses. You're going to see businesses and factories move more into technology to improve worker efficiency, which will allow wages to rise and margins at the same time without increasing prices. So there's natural dynamics of response to these sorts of stimuli, and they're very strong stimuli. And we see them already starting to take place. That's why we're tracking things like transportation costs. As those come down, it tells us that companies are adjusting. Supply disruptions are beginning to ease, but they won't be fully recognizable to most consumers until probably the middle of next year. And by that time, we think inflation will start to recede, both in the wage area and also in the goods area.
Later this morning, we're going to get the JOLTS report on job openings and labor turnover. The estimate is for 10.3 million openings. How quickly will these jobs be filled, you think, Paul? Because it's been at this level for months.
Yeah, it's going to take more months, Dagan, because you've got people still who are comfortable. Look, the market's up. If you have a 401k and you're 55 plus, a lot of those folks have stepped out of the workforce. According to the Labor Department, about 2 million of them have stepped out of the workforce. So they're gone for good, along with their higher wages, by the way. And what we're starting to see is more participation from 16 to 54-year-olds. And as that continues, and again, as those savings come down, and it's not profligate spending, it's even food and gasoline. Gasoline up by 50%. People have to use their savings for that. They're going to run out of money. They're going to need jobs, and they're going to come back into those industries where we have the most job openings right now. That, again, is manufacturing, leisure, and hospitality.
Paul Christopher, thank you for being here this morning. We'll see you again soon.
Thank you.